If your portfolio has more ETFs than your fridge has condiments, yeah, you might be overcomplicating this. People think building wealth means owning a piece of everything, but what if it's actually the opposite? In 2025, the smartest portfolio might not be the one with 20 moving parts, it might be the one with 3 ETFs. One to anchor your money, one to accelerate your growth, and one to pay you while you wait. In this video, I'm going to show you how to build a powerful 3 ETF portfolio that anyone can start, even with just $10,000. We'll track how that money grows over 1, 10, 20, and 30 years. And in the end, I'll combine all 3 ETFs into a single portfolio that can turn a daily $10 investment into a $1 million portfolio. But first, let's set the stage and explain why this matters. According to the Federal Reserve, the average retirement savings for American families is about $334,000. That is total after decades of working, saving, and investing. But here's the thing. If you simply follow the 3 ETF portfolio strategy that I'll be showing you in a couple of minutes, putting in $10 a day, reinvesting dividends, and staying consistent, your portfolio could grow to over $1.15 million in 30 years. That's not just beating the average, that's tripling it. The idea of building wealth with just 3 ETFs comes from one of the most proven strategies out there, the 3-fund portfolio. It was popularized by the Bogleheads, a community of investors who follow the simple, powerful philosophy of Vanguard's founder, Jack Bogle. Their approach? Own the entire market with just 3 funds: total U.S. stocks, total international stocks, and bonds. It's clean, efficient, and built to last. I'm taking that same core strategy and giving it a more modern twist, updated for the world we live in now. But before you throw your money in, there are 3 rules you need to follow to make this strategy actually work. Rule 1, pick just 1 ETF from each of the 3 categories we're going to talk about. Not 2, not all, just 1 per category. That keeps your portfolio clean, clear, and powerful. You don't need 20 different ETFs to win big, just 3 solid ones, each doing a different job. Rule 2, know your goal. The whole strategy only makes sense if it matches your timeline and comfort with risk. If you're in your 20s or 30s with decades ahead of you, your portfolio might lean heavier on growth. But if you're closer to retirement, you'll want more stability and income. Either way, your age and risk tolerance should guide your ETF picks and how long you stick with them. Rule 3, be consistent. The magic isn't just in picking the right funds, it's in letting time do its thing. That means holding on through the noise, reinvesting dividends, and not panicking when the market dips. The longer you stay in, the more the compounding snowball grows. Okay, so now let's break down the first category. The foundational ETF, the one that anchors your portfolio no matter what the market throws at you. Every solid portfolio needs a backbone, something reliable, something you can count on through recessions, market bubbles, and whatever chaos the news is yelling about. That's what this ETF is for. I call it your foundational ETF, and this should be your exposure to the total U.S. stock market. Why? Because instead of betting on one company or even one sector, you're betting on the entire American economy. When the U.S. grows, so does your money. And history shows that it works. Over the long term, the total market has delivered strong, consistent returns, even with the occasional crisis or crash. Whether it's 2008, 2020, or the dot-com burst, these total market ETFs bounce back. You just need time. Now sure, there are tons of total market funds. Some follow the S&P 500, others track the entire U.S. stock market with thousands of companies. The idea is the same: ride the wave of the American economy without having to pick individual winners. Think of it as a giant basket of stocks. So when tech is down, healthcare might be up. When retail stumbles, energy could carry the weight. It balances itself out. The ETF I've chosen for this foundational category is the Invesco S&P 500 GARP ETF. GARP stands for Growth at a Reasonable Price. Basically, this fund looks at the 500 biggest companies in the US and cherry picks the ones that are growing fast and still reasonably priced. That combo is rare. Most funds either chase growth, regardless of price, or go super conservative. This one threads the needle. It focuses on companies with healthy earnings growth, sustainable profitability, and smart valuations. That's why it's more than just a mirror of the regular S&P 500. It actively filters out overpriced or underperforming names. Okay, so let's talk names. Yes, you'll find the classics like Microsoft, Apple, and Meta, but the GARP strategy also tilts towards rising stars in sectors like healthcare, industrials, and consumer services that are often overlooked by flashier funds. That balance gives it long-term legs. And of course, the dividends don't hurt either. Even though it's not a high-yield ETF, the consistent dividend income when reinvested creates a compounding effect that seriously boosts your portfolio over time. It has an average yield of 1.55%, which on average grows about 11.1%. And to top it off, over the last 10 years, on average, each year this ETF has grown by 11.28%. Based on these metrics, let's say John puts $10,000 into this ETF today and reinvests the dividends he gets. After just 1 year, his portfolio would grow to $11,283. Fast forward 10 years and it'll be valued at $33,401. Stretch it to 20 years and John's portfolio will be worth $111,294. And by year 30, his initial $10,000 is projected to reach $369,950, paying around $4,827 in annual dividend income. Out of that, $317,955 would come just from capital appreciation, and $41,995 would come from reinvested dividends. So the total value added to the initial investment would be $359,950. That's not just growth, that's smart growth, built slowly, built safely, built to last. Next up, I'll show you more ETF categories, and in the end, I'll combine all 3 ETFs into a single portfolio that could turn a daily $10 investment into $1 million portfolio. But while this ETF anchors your wealth, it won't get you those explosive gains some investors crave. You know, the kind of growth that turns heads and builds wealth faster. So next, let's introduce the heavy hitter into our trio. The second category is the international ETF. Now that you've got your foundation set, let's talk about the second piece of the puzzle, the one designed to put your portfolio on steroids. Traditionally, this is where financial advisors would tell you to add some international exposure. That used to make a lot of sense. You'd invest in companies from Europe, Asia, or emerging markets to spread your risk beyond the US. The logic? Different countries perform differently at different times, so you stay balanced. But here's the reality in 2025. Many American companies are international. Apple sells iPhones in China, McDonald's flips burgers in Brazil, Microsoft powers offices across Europe. So if you're already investing in top US companies, you're indirectly getting exposure to global markets anyway. That's why instead of spreading into a generic international ETF, I prefer to pivot towards something with serious growth potential. I'm talking about innovation, disruption, future-focused companies that don't just participate in the economy, they shape it. And that's where Invesco QQQ Trust, ticker symbol QQQ, comes in. This ETF tracks the NASDAQ 100, which includes 100 of the largest non-financial companies listed on the NASDAQ exchange. These are not your average value stocks. They're fast-moving, high-growth titans of tech, biotech, and communications. QQQ is like stepping on the gas. It doesn't try to be defensive or diversified across every sector. It leans into what's growing, what's winning, and what's dominating our lives in real time. These companies build the tools we use, the networks we connect through, and the innovations we don't even know we need yet. And it's not just tech in the traditional sense. Inside QQQ, you'll find exposure to areas like semiconductors, cloud computing, e-commerce, AI, digital advertising, and even healthcare innovation. That kind of sector spread within the innovation world gives you powerful diversification even inside a tech-titled ETF. Now, let's be clear, it's not for the faint-hearted. QQQ can swing more during market dips. It's not as safe as our foundational ETF, but with risk comes reward. And over time, QQQ has absolutely delivered. It has outperformed the broader market consistently over the last 2 decades. Even after corrections and crashes, it has bounced back stronger than ever, largely because of the underlying strength of the companies inside. These aren't just speculative startups, they're profitable, dominant, and flush with cash. In fact, QQQ's top holdings are often the very same companies that lead the charge out of recessions. While some funds sit on their hands waiting for a rebound, QQQ is often leading the way. It pays a 0.61% dividend, and those payouts grow around 10.3% each year. Even better, this ETF has averaged 16.36% growth every year for the last 10 years. So here's how it plays out in real dollars. Let's say John puts $10,000 into QQQ today. After just 1 year, his portfolio would grow to $11,697. Fast forward 10 years, and it'll be valued at $47,366. Stretch it to 20 years, and John's portfolio will be worth $220,210. And by year 30, his initial $10,000 is projected to reach $1,013,614. Out of that, $994,266 would come just from capital appreciation, and $9,348 would come from reinvested dividends. So the total value added to the initial investment would be $1,003,614. That's what happens when you give growth the time to do its thing. So while the foundational ETF is like the reliable sedan that gets you safely from point A to point B, QQQ is the turbocharged sports car. Yes, it can be a much bumpier ride, but it can fly. And that's exactly what this category in your portfolio is all about. You need something with enough power to accelerate your returns over time. That way, your total performance can outpace inflation. Now, if you only had these 2 ETFs, the foundational one and QQQ, you'd already be in a strong position, but we're not done. There's one more category left, the final layer that brings in income, adds stability, and makes your portfolio more bulletproof. The third category is a bond total market index fund. You've got your reliable base, you've got your rocket-fueled growth. Now it's time to add the final layer, one that brings balance, consistency, and real cash flow. Traditionally, this third category would be filled by a bond ETF. That made sense for decades. Bonds were the go-to option for income and safety, especially for older investors or those approaching retirement. But let's be honest, bond returns today just don't cut it. With interest rates playing a game of limbo and inflation eating away at purchasing power, bonds have become more like a speed bump than a wealth builder. So here's the shift. Don't use bonds in this portfolio. Use dividend-focused ETFs instead. And the one I trust most is the Schwab U.S. Dividend Equity ETF, or SCHD. This ETF is like the wise old investor in the room. It's not flashy, it's not chasing hype, but it consistently delivers solid dividends from rock-steady, cash-rich companies that have stood the test of time. Why choose this over bonds? Well, let's compare for a second. When you buy a bond, you're basically lending money to the government or a company. They pay you interest, but that interest rate is usually fixed, and these days, pretty low. Plus, bond prices can actually fall when interest rates go up, which means you can lose money and get paid less. Not ideal. But when you invest in SCHD, you're becoming part owner in real businesses that generate profits, share those profits with you, and increase those payouts over time. That means not only do you get income, you also get growth. Try finding that combo in a bond. Now, someone might argue, but dividends aren't guaranteed either. That's true. But the companies inside SCHD are chosen specifically because they have strong balance sheets, a track record of consistent dividends, and the ability to raise payouts even in tough markets. It's one of the most selective dividend ETFs out there. Another plus is that SCHD isn't concentrated in just one sector. It's diversified across consumer staples, healthcare, industrials, and financials. That spreads your risk and smooths your returns. When tech takes a hit, your dividend ETF probably won't flinch much. It has a dividend yield of 3.99%, which on average grows about 11.3%. And over the last 10 years, on average, each year this ETF has grown by 7%. Let's put that into perspective. Let's say John puts $10,000 into SCHD today and reinvests every single dividend he gets. After just 1 year, his portfolio would grow to $11,099. Fast forward 10 years, and it'll be valued at $30,662. In 20 years, John's portfolio will be worth $117,692. And by year 30, his initial $10,000 is projected to reach $630,059, paying around $70,715 in annual dividend income, or about $5,893 in monthly dividend income. Out of that, $243,029 would come just from capital appreciation, and $377,030 would come from reinvested dividends. So the total value added to the initial investment would be $620,059. That's the beauty of replacing bonds with dividend stocks. You're not just getting paid, you're building wealth at the same time. Compare that to a bond fund where your $10,000 might grow to maybe $20,000 or $30,000 over 30 years with far lower income and almost no reinvestment engine. SCHD blows that out of the water, plain and simple. This category is all about financial peace of mind. It's the sleep well at night section of your portfolio. And in volatile years or when growth stalls, having a steady stream of cash coming in can help you stay invested when others panic. So now you've got your foundation with the total market, your growth with QQQ, and your income and resilience with SCHD. You don't have to choose between them because the final piece of this strategy is how you combine them all three into one unified compounding machine. So how do I balance all three of these ETFs? Simple. I give them equal weight. 1/3 in the foundational ETF, 1/3 in the growth-focused QQQ, and 1/3 in the income-generating SCHD. You can have different percentage allocations, but for the sake of keeping things simple, I'm using equal contributions across all three funds. That way, my portfolio is diversified across stability, growth, and income. Each ETF plays a unique role, and together they form a strategy that's both aggressive and grounded. Perfect for long-term wealth building without the guesswork. Let's say John builds this portfolio by putting $10,000 into each of the three ETFs, GARP, QQQ, and SCHD, and reinvests every single dividend. After just 1 year, his total portfolio would grow to $11,360. Fast forward 10 years and it would be valued at $35,597. Give it 10 more years, and in 20 years, John's portfolio will be worth $125,325. And by year 30, his initial $10,000 is projected to reach $436,690, paying around $6,549 in annual dividend income. Out of that, $369,804 would come just from capital appreciation, and $56,886 would come from reinvested dividends. So the total value added to the initial investment would be $426,690. Now, let's say you don't have $10,000 to invest in each of these ETFs. Let's say you or John invest just $10 a day. No big lump sum, just a daily habit. In 1 year, you've put in about $3,640. This sets the stage for future growth. Fast forward 10 years and that small habit turns into $68,766. By 20 years, you're looking at $310,506. And after 30 years, over $1.15 million from just $10 a day. By year 30, it's paying you $17,177 a year in dividends, around $1,431 every month. Passively, most of that growth came from capital appreciation, about $902,897, and another $137,992 from reinvested dividends. Of course, this isn't a one-size-fits-all plan. Remember Rule 2, it all depends on you. If you're younger and have time, maybe you can lean a bit more into QQQ to supercharge your growth. If you're closer to retirement, you might tilt toward SCHD for income and lower volatility. The key is in knowing your goal and adjusting the mix accordingly. But here's the real takeaway. Whether you want to get rich slowly, fast, or somewhere in between, the path is clearer than you think. It's not about having the most complex portfolio or finding the next unicorn stock. It's about having a system that actually works. That's what this 3 ETF setup gives you. Don't have the initial $10,000? Click the video on the screen to find out how to make $6,000 a month with only $20 per week.